So now let's go ahead and look at the blue sky model. And we're going to look at that as a precursor to thinking about a net tangible assets model. By the way, I don't know that that term net tangible assets model is pervasive throughout the valuation consultancy space. It's a term I'm giving it simply to differentiate it from the blue sky model, which we recognize is used predominantly in the automobile dealership and heavy equipment dealership space, RV dealerships, etc. And we can find some of the elements of this in the Hague and the Kerrigan report, and we'll think about that model, how it's composed, and then we'll transition that to thinking about a net tangible assets model. So first, let's look at that blue sky model. When we think about the blue sky value, we are going to think about EBITDA times the blue sky multiple, again, that we've picked up from the Kerrigan report or the Hague report or one of those other credible repositories for that valuation multiple for those kinds of businesses. And then we're going to add to that value that we've created from that multiple times the EBITDA variable. And we're going to add net tangible assets to that. And the tangible assets that we're interested in here are the non-depreciating assets. So this would be some of the real estate, of course, because land is not depreciating. And then any high value inventory, because we don't depreciate inventory. So we'll look at those and we'll add them together. And we'll think about whether or not this is a construct that we can use for other businesses that are not in the auto dealership or the RV dealership or the heavy equipment manufacturing dealership space. And we can, because we know that we have two separate values for a company that we have to think about that need to be added together when the company has significant non-depreciable and marketable assets. Let's say that I have my dry cleaning business over on the corner of 13th East and 106th South. And if I rent that space and I have a cash flow from that business, I can create a value for that business. And let's say that the value based on my cash flow ended up being $200,000. But if I also happen to own the building that I'm in and the land that it sits on, and if that's worth maybe $2 million because of where it sits, then I can't ignore the richness of that part of the business's value, assuming the business owns the asset being a real estate. Now, in most cases, we don't have this problem because in most cases, real estate is not owned by the business. It's owned in a separate entity that would be valued simply based upon the market value of the real estate minus any mortgages against the real estate. But that's the net tangible asset, right? The value of the asset minus any mortgages or debt against it. If they're owned in one shell or one composite, we need to think about both elements of value and put them together. The cash flow value, which we might see through a market approach or a DCF approach, and then the net tangible assets of this nicely valuable real estate or maybe even nicely valuable, high valued inventory, neither of which are depreciable. We wouldn't be including in this kind of evaluation other depreciable assets because those would be accounted for given some of the other deductions we make either for rents or for depreciation or what have you within the business. So let's go on a little bit further with this. So I've told you that what we're going to do here with the blue sky, but now let's think about it from just a net tangible asset model construction. So I'm going to say that value based upon a net tangible asset model is going to equal whatever the estimated value is, market or DCF from the cash flows, and even a market multiple model is going to have a cash flow component to it because it's going to be an enterprise value multiple. That's going to be enterprise value divided by EBIT or enterprise value divided by free cash flow or enterprise value divided by EBITDA or SDE. All of those have a cash flow component to them. So that's a cash flow value. It's an estimated value of the business because of its cash flows either through a market comp or through a DCF. And then to that, we're going to add these net tangible assets. So we're using some of the same methodology of the blue sky model. We're just not using specifically a blue sky multiple as published in the Hague or the Kerrigan reports. So we're going to have to make some adjustments to the cash flow though. We're going to remove any expenses associated with the tangible assets, and we're going to add expenses of renting similar assets at market rates. Now this is not unlike we did when we got to SDE a few minutes ago, again for Autumn View. When we calculate the net tangible assets, we're going to start by looking at non-depreciable assets, inventory that's high dollar value, land and other fully depreciated assets at their market values. So we're going to include land because we don't depreciate land. And we're going to include other fully depreciated assets because, again, we don't depreciate them any further. They're already fully depreciated. And so whether they are real estate oriented or not, we're going to include those in our net tangible assets. Maybe it's a production line, maybe it's a warehouse, maybe it's a truck or a tractor, and it's not real estate, but it's fully depreciated, but it still represents a value to us, because if we sold the business, we're going to get something for that tractor over and above the cash flow that it generated. The cash flow it generated has already been cost through in the depreciation and the release expense or whatever we had as we were acquiring the piece. And then we're going to think about calculating any debt against the assets. So that would include financing lines on any of this inventory. For example, I know that a company that sells high value technology, so computer servers and such that might cost a user or consumer, which might be a business, might cost them $200,000 or $300,000. Well, that's going to be brought into the company as inventory, but the manufacturer very often will finance that inventory for the business to whom they've sold it. And again, this business is not the end user. This is our business, let's say in this case, Autumn View Associates, and this is some of the technology that they acquired that they might even inventory to pass on and sell to customers. But because it's inventory, it's not going to be depreciated. And so we can consider it as one of our net tangible assets, and most often, rather than financing it themselves at the business level, the Autumn View Associates level, it's going to be financed by them through the manufacturer, which does a couple of things. It motivates the customer, in this case Autumn View, to buy more inventory from the manufacturer because it's being financed by the manufacturer, typically at little or zero interest rates and little or zero down. It increases sales for the manufacturer when they sell it to the Autumn Views of the world, and it gives Autumn View the opportunity to not have to go out and order it and have a lengthy order period. So there's pros on both sides of the equation here, and the pro for the customer, the end user, is there very often the inventory is available right now. This is what we see in the automobile dealer space, by the way. If you go by the Jerry Signers or the Miller dealerships, you see these hundreds and thousands of cars lined up on Auto Row and such. You think, oh my gosh, how is it possible that they can afford to floor all of that inventory? Well, they don't. Ford, General Motors, Nissan, Hyundai floor it for them at very low financing rates and at very low, if any, down payment at all. The difference between this and an account payable, if you will, would be that as soon as the inventory sells, the amount of it that was financed is due and payable immediately, whether that's one day after it came onto into the inventory, or if it's 90 days. So it's not like it's a 30, 60, 90-day account payable cycle. It's a cycle that begins when the inventory hits the business owner's space, and it ends when that inventory leaves the business owner's space. So we need to think about any of the financing on that, plus then we need to think about any financing that has been collateralized with any of the other assets that we're going to consider for net tangible assets. So for example, real estate. If we have mortgages on real estate, then that mortgage is going to be a debt against which we net out against the value of the real estate to get the net tangible asset. So we're going to take the net tangible assets as being equal to select assets on the balance sheet that meet the criteria that we're discussing, minus any associated debt. And in this case, we can see some of the outcome of the net tangible assets model. And this is also letting us see a little bit of the outcome of just the seller's discretionary earnings. So I have here Autumn View Associates. You're very familiar with the structure. I've got a forecast here, but notice I have not forecast debt. I have not forecast invested capital. I'm not forecast fixed assets. I'm not forecast change in net working capital. I simply am forecasting those elements that lead me to seller's discretionary earnings, because in this case, I believe that the balance sheet is problematic. or the firm is such that trying to forecast their balance sheet isn't a useful exercise for us. So I'm only including the items here that you would consider in forecasting seller's discretionary earnings, which is the tax-adjusted EBITDA, after I've already adjusted the EBIT for those sellers' items or those owners' items that they've plugged into EBIT that they shouldn't have, or they haven't plugged into EBIT that they should have. So here I've got my EBIT and my adjusted EBIT and my adjusted no plat and my SDE forecast. And I then go ahead and set up a multi-columnar valuation construction where I take those SDEs as the cash flows. I then, for the 3 years of the explicit period that I'm running, I take the discounted value of them based upon my weighted average cost of capital at 8.89% and my ROIC at 10.88%. And then I take the sum of those, and that's the present value of my discounted cash flow. I then take against that the continuing value, which, like we just normally do, the continuing value is going to be taking the cash flow, or in this case SDE at time 1, and dividing it by WACC minus G. And then I'm going to discount that back to today. And then the sum of the present value of the discounted cash flows plus the present value of the continuing value is the SDE value of this asset. So you can see I'm simply using SDE as I would use any other cash flow variable, and recognizing that it is the cash flow available to the existing owners, stakeholders, or potentially new owners and stakeholders. But now we're considering this business holds some meaningful assets as well. It's got some high dollar inventory. It's got some real estate as well. So let's move to the spreadsheet in which I've modeled this for a second, so you can see some of that. And you'll notice here that we've got some inventory at $186,000. And I'm telling you that this inventory is high valued inventory in the technology space. This is servers, etc. And then we've also got some property valued at $690,000 here. So we've got to think about those as the assets that we would bring into the SDE equation, or rather the net tangible asset equation. Against the inventory, we have $120,000 in financing, and this financing is ours by virtue of the manufacturer having extended it to us. And we have some mortgage bonds that are collateralized using the property. So now we can create a net tangible asset space. So as I calculate net tangible assets, you can see I'm pulling those values from the financial statements. And I'm taking the inventory here in E17 plus the real estate in E12 and subtracting from it the financing for the inventory and the financing or mortgage for the real estate. And that gives me a sum of 289.7 for net tangible assets. And then I can go ahead and add that to the valuation that is strictly a function of the seller's discretionary earnings. And it gives me an overall valuation of $3,761,802. Well, I would have missed 289.7 of that had I just done a multiples-based valuation, or if I just done a DCF valuation. You can see here that I've got a multiples-based valuation as well. I've done the same thing, and you'll notice that the SDE multiple is going to seem very high to you. This is not an EBIT multiple. It's not an EBITDA multiple. It's not a free cash flow multiple. It's an SDE, or a tax-adjusted EBITDA multiple. So it's going to have a different number to it. And so it's not nearly as high as it looks just by seeing it at 23.75. It's only high if it's high comparison, by comparison to other firms with similar multiples or similar constructions. But to the value I create here, which is not meaningfully different than the value I get from the SDE discounted cash flow, I add to that the net tangible assets, and it gives me the value of the entire entity, the cash flow base of the entity, and the tangible assets, the saleable, non-depreciable assets of the entity. And again, these two values are not all that different. Using the SDE discounted cash flow with a net tangible asset, rider, we've got 3,761,800. And when we use the multiples base plus the net tangible asset rider, we've got 3,776,96. So insignificantly different, and they may set up a range of acceptable values for us. And you can then see how I can go yet the next step, and I can now take these and I can identify the per share values, and I can identify our goodwill value. So it's worth going through that. Remember that we're going to use the entire value. So whether it's the cash flow plus net tangible asset, or it's the multiple plus net tangible asset, we're going to use both of them here. And we're going to identify two separate columns, one for each type. So here in this first column, I'm looking at the discounted cash flow using SDE. And in the next column, I'm using a multiples base at the values that we saw a few minutes ago. I know that in this case, I've got 544 shares of stock. Actually, it's 544,000. Again, everything in this is in thousands. And I'm going to recognize that I can reverse engineer the equity by recognizing that I've got enterprise value equals the market cap of the equity plus the market cap of the debt minus cash. Well, I can change that having already estimated enterprise value. So I'll substitute these valuations for enterprise value. And now what I'm going to solve for is the market value of the equity. And I do that, and we know we've done this before. So I'm going to take, to find the equity, I will take equity equals enterprise value minus debt plus cash, and it brings me to 3,253,000. And when I use the multiple, it brings me to 3,268,000. Well, if I divide those values by the shares, I end up at a per share price of 5.981 and 6.009. And that makes sense to us. That's not dissimilar to what we saw if you were looking at it on the balance sheet, or rather the financial statements. In fact, at the same time, we saw that we had already estimated the value or the price of these shares at $5.50. So this is a little bit more, which would suggest to us that the actual value of this company is greater than the price that's been assigned to it by whatever market mechanism assigned that. And so we might suggest that this is a good buy for us. We might be interested in this company because the price that we could get it for looks to be less than its actual value to us. Well, if I want to go ahead now and move this to a goodwill value, I recognize that tangible assets plus goodwill, or intangibles, so tangible assets plus goodwill equals total liabilities plus owner's equity, and goodwill being the intangible asset. This stemming from the balance sheet equation of assets equals liability plus owner's equity. And we've been through this a number of times before, of course. So I know my tangible assets, they're right on the balance sheet. I know my liabilities, but I'm taking the market value of my liabilities. So I had to calculate the market value of debt. You know how to do that. I added to it the the book value of the other long-term debt that we couldn't calculate a market value for. But this is all equities, or rather all liabilities. So I had to also add to this the current liabilities. So I have the market value of all of my liabilities here. And I know my owner's equity because owner's equity is the equity amount that we calculate up here when we do the equity valuation that we then break down to a per share amount. And so it's the same 3,253,58 as we're looking at the SDE valuation, or 3,268,74 if we're looking at the multiples-based valuation. So that's my owner's equity. Well, if total assets equals liability plus owner's equity, and if total assets equals tangible plus intangible assets, I can rewrite the equation that says intangible assets, or goodwill, is equal to liability plus owner's equity minus tangible assets. And so that's what I've done, and it helps me find my goodwill value of 2,570,92 or 2,586,07. I hope this has been a little bit instructive for you. My guess is I've gone a little faster through some of this than you might have liked. It's not uncommon for us, of course, but I also think that if you'll watch this and think about everything you already know, that this will help inform a few of the questions that you might be facing on the qualitative exam coming up soon.